Do we have any historical evidence that lowering tax rates, particularly among the richest strata, generates economic growth, as Republicans always predict? Has this ever worked? A reader. The answer is no. As Congress tackles tax reform, we really don't have conclusive historical evidence of the relationship between tax rates and economic growth. To be sure, studies abound, but they are of two distinct types that, at least superficially, contradict each other. The first approach compares tax rates with individual behaviors that should be good or bad for economic growth. Do lower taxes stimulate entrepreneurship and business investment? The answer, say some of these studies, is yes. Lower taxes encourage pro-growth behaviors. Higher taxes do the opposite. The economy's overall growth is assumed to benefit or suffer. It's this approach that the Trump administration touts in proposing that the top corporate tax rate be cut from 35% to 20%. The result will be a surge of business investment, which in turn will lift the wages of U.S. workers, says Kevin Hassett, chairman of President Trump's Council of Economic Advisors. As companies invest more in computers, software and other technological advances, workers become more productive. Because they are valuable, their wages will rise. Hassett has predicted, controversially, that enactment of Trump's corporate tax cut would result, over perhaps a 3 to 5 year period, in wage gains of $3,000, $7,000 for households with median income, $59,000 in 2016. A $3,000 wage increase would represent a 5% gain. Be skeptical, cautions the second type of study. Rather than examine the effect of these taxes on individual behaviors, it compares tax rates with the overall growth of the economy, gross domestic product. Do lower tax rates cause faster GDP growth? One prominent study by Jane Gravel of the Congressional Research Service found little connection. This doesn't mean the taxes have no economic effects, but the effects are often swamped by other influences. Economic growth is an incredibly complex process. Aside from government policies, here are some other factors that determine growth: new technologies, the business cycle, the quality of managers and workers, shifting demographics, women's entrance into the workforce, an aging population, the competitiveness of markets, inflation and much more. The 1950s showed how this worked in practice. After World War II, there was a huge backlog of consumer demand for cars, housing and appliances caused by the interruptions of the Great Depression, 1929 to 1939, and the war, 1941 to 1945. Similarly, new technologies were waiting to be exploited: synthetic fibers, passenger airplanes, television. Given the wartime destruction, the U.S. dominated world trade. These were the forces that propelled the economy. Some advocates of lower tax rates overstate their case. Like many others before him, Trump has credited Ronald Reagan's 1981 tax cuts for the strong economy of the 1980s. At best, this is an innocent exaggeration. The real catalyst for the 1980s boom was the conquest of double-digit inflation, which fell from 13% in 1980 to 4% in 1982. This lowered interest rates and initiated a bull stock market. The truth is that, among economists, there is no consensus on the role of tax rates in explaining economic growth. Some economists support Hassett's general approach, others don't. Most critical has been Lawrence Summers, Treasury Secretary under President Clinton and once a top advisor to President Obama, who, in a series of blistering commentaries, has dismissed Hassett's analysis as wrong and justifying a giveaway to the rich, who own much corporate stock. Companies have ample cash to finance new investment, he says. If they don't invest, added tax cuts won't change their minds. But it's essential that the lower rates be achieved by ending tax preferences as opposed to borrowing. To run up the debt to finance tax cuts for favored constituencies, as the Republicans propose, is not an exercise in enlightened economics. It's politics at its most cynical. Robert Samuelson is a columnist for The Washington Post.